everybody can see the questions. And we're now recording. And I'm going to share some questions. And we're still getting some background noise from someone. So if you guys could, please mute your mics. Steve, can you see the questions?
Oh, yeah. Yeah, I've got them.
Okay.
It would be interesting if you had recorded that, that hassle we just had. That would have been fun hearing everybody speaking, telling me over and over that they couldn't hear me. It was interesting.
Yeah.
Anyway, we're here.
All right, we're all here. Just a reminder, everybody, this meeting is being recorded. Please mute unless you want to ask a question. And then there's some disclaimer information here that Steve insisted on. And Steve, I'm going to have you take it away, and I might even mute myself because I do have some background noise here.
Okay. I guess I just wanted to say at the beginning that these two groups have really been quite an experience over the last couple of years, and I think they've been particularly important because of COVID and what's been going on in the financial community and everything else. And if you belong to several groups, you know how good the behavior is in these groups. I can't understand why we're getting so many spammers. We must be pretty popular to attract all these people, but we're doing as best we can to get rid of them. But I got to say that, I really appreciated the interactions that you guys have amongst yourselves and the ones you have with me. It's been very productive. I have to admit that I learn a lot from your perspectives, and I hope you get the same from me. But it's been a good experience, and I guess it's been a pretty good experience for all of us. So let's get into this. Basically, everything we're talking about and recommending or suggesting, etc., is based on those basic principles, at least in my mind, that I keep in my forefront anytime I approach an investment decision, and that's the quality of it, my diversification overall and within the situation, income production, and then, of course, there's that profit-taking thing that we haven't had nearly enough of lately. Mm-hmm. So saying that, the first question is, I'm not drinking scotch, I'm drinking water. How should we view the CEFs and the relationship to interest rates? I think if there's any area, most people don't own a whole lot of individual fixed income securities. I haven't owned an individual bond since the last one matured maybe 15 years ago. But if you look at the income closed-end funds, it will show you precisely how closed-end funds, pretty much both varieties, should be expected to react to higher interest rates. In my universe, there's only about one or two in anybody's portfolios that are positive. There's no green. I guess, Larry, I know you're here. Larry, I'm here. I know you like to look at green in your portfolio, but you're not seeing much now, and neither am I. I did manage to scrape out some any profit at all transactions today, maybe 5 of them, and they were mostly in the equity type closed-end funds. But profits have been really slim to none lately, and everything is down. Let's say you had a portfolio, let's say you had the same situation like this 7, 8 months ago when everything was up, and you had a portfolio that had half of them down, I mean closed-end funds. You'd start to wonder about the selection of those particular funds because they aren't going the way of the group. This is a large group. They're all different sectors, perhaps, and they own a lot of different stuff. But their reaction to rising interest rate expectations are the same. Theoretically, they can't be, you shouldn't expect them to go down a whole lot more on account of interest rates unless we get some announcement that continues the Fed's policies into another year. Okay? We know it's going up another 0.5%, what, next month?
Yeah.
And we know there's probably going to be a couple more. Well, if we know it, everybody else knows it. And clearly, because I know none of us have been selling any of these, somebody else doesn't agree with us, you know. So most of the closed-end funds are probably owned by larger investors who have, and because they have smaller floats than common stocks, the pressure downward is probably caused by them, because our buying, as I know we all are, hasn't been able to rise the prices any. And face it, these things are just like stocks when it comes to their prices. They're based on supply and demand. If there's more sellers, they go down. So, and that's what we've got out there today because of interest rates. And just like with the stock market, there are people out there that think they can time the bond market as well. I would guess, and it happened in 2008. I don't know if any of you were in closed-end municipal bond funds then, back in 2008. But by the time we reached late 2009 into 2010, closed-end municipal bond funds regained their highs and began becoming profit-taking opportunities well before the S&P got back to where it had been in late 2007. So that's the type of expectations you should have. Eventually, particularly if, typically the worse it gets, the more people start to go to safety. And safety in money market funds today just doesn't produce enough money like it did back then, where you could put it in a way at 4.5%. That wasn't so bad to sit on cash. But now you're sitting at cash, even with the increase in rates, that's probably less than 1%. I haven't looked at the money market fund on my account statement recently, but the amounts of money I'm getting on interest don't seem like very much. So yeah, this is how we have to view the relationship. CEFs are interest rate sensitive, interest rate change expectation sensitive, and they will follow inversely with interest rate expectations. So they're doing just what they should be doing.
Yeah. Hey, Steve. So to your point, what you mentioned just a few minutes ago, would you expect the municipal bond CEFs to kind of lead the pack back up? Not really.
Yeah. The higher interest rates get, the more likely that it is, because it's the more likely that wealthy people will start to find them attractive again.
Okay.
And to get them from, you all saw my note about the 24 portfolio I put together.
Yep.
That's yielding over 6%. I mean, if I was in how high the tax brackets go? 35?
Yeah.
If I were in a 35% tax bracket, a 6% yield, tax-free, particularly if I was in New Jersey or New York, would be pretty attractive to me. So that you're going to start getting demand from that sector, from that sector of investors, I should say. First, yeah, I would think so. I mean, they certainly have the wherewithal to dump large sums of money in there.
Yeah.
Whereas most of us, each month we're going to buy a little more, But
sure.
Those guys go big. They can buy entire companies just like that. Snap of the fingers, and I'm paying $43 billion for a new company.
Yeah. All right.
Anyway, yeah, I think that's what you could expect. I think the municipal bonds, I mean, if it makes sense to have them in your portfolio, now is certainly a time to add some. But there's, when everything is down, there's so much to do, and there's not enough money. All your regular ones are down. Some of them as much as 20%, perhaps. The equities are bouncing around nicely, but some of them, I'm buying some of those that are down over 10%. So, there's so much to do. Spread it around.
Yep.
Spread it around. Stay diversified. Don't go above 5% in your six-figure portfolios or your total investment portfolio. You know what I mean? If it's bigger than that.
Yep.
So.
Okay.
Anybody have any other questions on that particular, on the general idea of interest rates and the relationships?
Yes, really, Steve, what you're saying is those rates, or the prediction of higher rates, is priced into those prices right now?
Oh, yes. We're certainly not the only ones that know about it. If we were, they'd be going up because we're doing all this buying. But no, everybody else knows what's happening and are taking things out of the market, because face it, that's what Wall Street this one's up there. Wall Street financial people always tell them, well, let's get rid of those bonds and we'll buy shorter term bonds because they won't go down as much. I mean, that's the sales pitch,
So this should be a good time to buy then, if you think that's priced in, that we've kind of hit bottom. Am I reading into that?
I didn't say hit bottom. I said it certainly should be priced in because it's common current public knowledge that rates will be being raised by the Fed for the foreseeable future. They haven't said we will stop at this percent and we will stop at this percent at this date. Okay. Once they say that, then you might see things coming back up again. But until then, yeah, this is a much better time than last time. And I can't say it's the bottom. No, I can't say that. What I can say is that a 6% municipal bond rate should be very attractive if you have a marginal tax bracket above unknown caller 25% or more. Okay?
Okay.
Yep, thanks.
All right. And again, you always look for quality. You always diversify. You know what I mean? You do the same. You look at these the same as you would any other investment. It's interesting that this group contained an average of over 360 issues. So you can see how well diversified they are. I mean, it's really, and it's it's the second level of risk on the pyramid. So, I mean, this was the first non-equity investment I ever made. Was a municipal bond back in 1970. My first portfolio investing. I mean, that was the first fixed income thing I did. Port St. Lucie, Florida, 30-year, 4% coupon bond.
They had bond funds in 1917.
Somebody mute that guy.
Yeah. we need an admin in here to take control.
Yeah. Anyway, it's great to have this subject lightened up every now and then. I expect some sort of humor on every number issue here. Okay. So when starting new positions, what percent of working capital do you start with? When and how much do you add? Well, I made notes on that. It depends on three things, really. Your portfolio size, okay? Where you think we are in the market cycle, and then your comfort level with the amount of money you get invested in any one security. Let's work back from the comfort level. I feel very uncomfortable with more than $50,000 in any one security, and that's even in accounts I manage with, $5 and $6 million in them. I like diversification a lot more than I like having that much money in. However, in on the lower levels of the pyramid, I think there's certainly justification to get up to that level if the portfolio permits it. And in these cases, a 5% of a $3 million portfolio is what, 150,000? So there's a long way to go before you go above the diversification guidelines, let's say.
Yep.
And then where we are in the market cycle. And there's I think you have two market cycles that are particularly important. That's the stock market and the interest rate cycles to look at. So relatively speaking, we're moving up from the bottom of the interest rate cycle, and we're moving lower and lower from the top. I think the S&P right now is down about 12%. When I stopped looking today, somewhere between 11 and 10%. So that's in terms of the last few years. That's as low as it's been, practically as low as it's been since March of 2020. And 2020, you'll remember, it wasn't there for very long. So no, I wouldn't be dumping uncomfortable dollar amounts into stocks that are down now. My approach is usually to try to add to as many different securities as I can, starting at the lowest cost one and working up. That's in adding to positions. When I start a new position, which is really what the question was, I don't ever start a position with over $10,000, no matter how big the portfolio is, even on my biggest portfolios. Typically, I don't want to go above 2% with a starting position. And I make this comment basically with accounts of six-figure accounts. Under 100,000, you can rationalize or justify going above that level because buying $150 worth of a security isn't a big deal, isn't great either. You know what I mean? So you want to have a couple $1,000s in the security for an initial purchase, pretty much no matter how small your portfolio is. And there are many closed-end funds that trade below $5, probably a dozen of them on the. And it's not likely that municipals would be in those portfolios anyway. So on all the other ones, you can find both equity and income CEFs, like CIF, CIK, DHF, DHY, NCV, and NCZ. Those are off the top of my head. And remember, these are not recommendations. They just happen to be issues that sell at those prices. So if your portfolio is small, spread it around. Try to keep about a minimum of $2,000 in any position as a starter level. As you move up, start getting to the point where you start out at around between 1.5% to 2% of the capital in the portfolio, and by the time you get all that done, then you should start developing a comfort level, both in percent and dollar figures. I don't, a very large portfolio, there are people who would have much more at risk in one security than I would. And I'd be a lot more nervous if it were an individual stock than it being a closed-end equity fund with 300 positions in it, if you know what I mean. So I think there's a lot of leeway. There's a lot of way you can look at this particular question, which is pretty much after quality diversification income, it's probably the second most important decision, isn't it? How much am I going to put out there? I mean, there is risk involved in any security. So yeah, I think you should look hard at this particular question and come up with a set of parameters that you're comfortable with. Okay.
Yep, sounds good.
Anybody? Any other questions?
Elliot, you have a question there?
Yeah, I got a question. So I'm transitioning right now to, actually, I just lost a yearly income, a workers' comp yearly income, and I got it replaced with the settlement. Settlement is
Yeah.
nowhere close to what I'm getting, but I'm transitioning right now with the settlement. I'm going to use that in my closed-end portfolio. I'm probably going to drop at least 150 grand into it, and to hopefully offset my financial loss from this workers' comp. And I just started this about a year ago, and I've been using the pyramid. I got about 45, 50 funds, including some preferreds. So I'm
Okay.
using it now, and it's a solid income base.
Yeah.
So I'm going to start transitioning. Once I get this, I'm going to start transitioning. I've been feeding it lately. I noticed that most of my bond funds there are down in the high teens to 20 plus %.
Okay. Well,
Oh, you
I have.
the other day.
I'll give, just so you're comfortable, that's not to be unexpected. I've had that same experience with the same, quality funds. They will be down in the current environment. But if you're, one of the things you have to be careful of in the case of starting up a new program is try to get that floor started, as I'm sure you're doing, with smaller positions, and get a good bunch of them. Don't do them all at once. I'm not buying more than one position for any person with enough money to buy anything right now. I don't buy more than one position a day, no matter how much cash he has available. So I have what I do though, and some of you might try this if you don't already. I have about 2 or 3 positions since there's so little money now to spend to reinvest. I have the time to say, okay, I can buy this, or this, and I'll buy the one that goes down the most tomorrow. And that's what I did today. So I'll put 3 things down that would fit in this guy's portfolio, but I'm only going to buy the one that's down the most or up the least, whichever it is. And I'm not buying anything that goes up more than 10 cents at all in this environment, because it's just too flaky. It's definitely a downward trend here. So
yeah, I got like a lot of limits set.
Okay, every order I place day limits, but I never go in with limit orders that are open limit orders. You know what I mean?
I do.
You're always day limits, and I'm also not one to place stops. I know a lot of you do that, and I think in an environment where you're only dealing with your own portfolios, it's a lot easier to manage than it would be for me. And I think that's why I've stayed away from that idea.
I pretty much, I put a limit in, I stick with that, and then I'll check it every day. I might adjust it a penny or 2, depending on what the law is doing. And
Okay. Is that on the buy side or the sell side?
Kind of both. I got caught up in a wash situation with about 5 different funds, so I got a few thousand that wasn't disallowed, so I kind of defeated that whole purpose of taking.
I think, didn't you mention that in the group recently?
I did, yes. Like the other day, I mentioned it, and you got caught up in that also. Well, you know what? It's a living situation, I guess.
Yeah, like I said to you then, that I was scratching my head about that too, because I thought I had counted out 31 days pretty good. So now when I do have that situation, I wait 60 days now. So anyway, okay. Did we cover that? Are we done with that one?
We're done.
Okay. Anybody else? Okay. All right. Question 3. In a down market, should we be thinking about changing our income equity allocation at all? And, that's a big capital letter, exclamation mark, no, for me. in my mind, asset allocation is a long-term planning device based on the risk you are willing to take in your portfolios and so on. So you determine, and based on your age and your retirement status and any number of personal things, mostly your risk tolerance. And remember, that even though these are closed-end funds, and we all feel, most of us anyway, that they're safer financially than an individual position, they still fluctuate, and there's still possibilities of loss. And the idea of, because the stock market is down now, over changing your overall risk scenario to take advantage of these opportunities goes against the grain of what if it doesn't work out? What if we have World War III and the stock market goes down another 80%, and all these distributions aren't made because they can't pay the money anymore? You're more likely to survive in the bond market than you are in the stock market. So no, your asset allocation should be pretty much written in stone and dependent upon your overall wealth, basically. I mean, if you've got gazillion dollars, you can afford to have 25% in the stock market in any way, shape, or form you want to. But if you've only got 700,000 and you're going to be retiring on that at around 55 or 60 years old, you've got to say, hey, I can't afford the risk of being in the stock market anymore, you know? So it's a whole different decision-making process, and it shouldn't necessarily, it shouldn't be adjusted by what's going on either in interest rates or in the stock market. Okay, it's a planning tool as opposed to a decision-making, an investment decision-making tool, if you can get the distinction. Okay?
Yep, sounds good.
All right.
Oh,
all right.
Looks like looks like Mike has a question. Mike, go ahead. Mike.
Go ahead, Mike.
Mike, I think you need to turn your microphone on. Mike,
I have an
your microphone on, so you might try the chat window. Steve,
okay.
Okay. So Mike he sent a message in the chat that he'll get it fixed. And so let's move on with questions, and he can send something through in the chat.
Okay. Okay. Question 4. I'm gonna need a little help on. Okay. At what point do we expect interest rates on new issues? That means new issues, meaning new bonds that governments or corporations sell to the public, or new preferred stock issues and so on, loans of some kind, whatever. New paper hits the market at a higher rate of interest. At what point do we expect these higher rates on new issues to offset net asset value declines and the increased leverage costs for the managers? And I really don't have a clue. And it's mainly because of me, and I don't focus a lot on either NAV or on the size of the leverage. I really let the managers, I trust that the managers have been able to go through these situations for a long period of time and can take care of it. So I know a lot of you other guys have spent some time studying the NAV relationships and things like that, and go ahead and dive into this one, and I can participate. But I really have no clue. I have no idea how raising rates impact NAV, other than the force, they go against the supply and demand for the stock that is holding the portfolio that's losing NAV because prices are going down. That's about all I know. So I don't know the answer to the question. Okay.
And I'm not sure who asked that question, but I think there in general, for a lot of us that are new to CEFs, there's a lot of concern about how interest rates are going to impact those highly leveraged funds.
Well, I guess what you've got to expect, if you're the manager and you're using leverage and you have to borrow money to find something to buy, right? And we're talking about short-term buying, right? Or borrowing.
Mm-hmm.
And you say, well, hey, this guy wants to loan me the money at 3.5%, and I can't find anything out there that's paying more than 3.5%. You either say to him, I don't want to borrow it because I don't have anything to invest in, or cut me a break and then I can invest it in something. Nobody's got a gun to their head to make them invest in a relation or borrow in a manner that would make them lose money for the shareholders.
Yep.
So my guess is that the relationship here is questionable in my mind in a managed portfolio. If this were an ETF where there were fixed amounts of things that they did and stuff like that, and there was no management involved, if it was more of a model or a program type environment, there might be such an effect. But yes, if you are in a portfolio with junk bonds only and not as well diversified as most high yield bond funds are, and you start getting a whole bunch of defaults, which, by the way, I haven't heard about any on the news or seen any in papers or anything. Then there is a relationship and a potential loss within, or a cut of a distribution and so forth. Generally speaking, the distribution cuts that we've experienced so far this year in the income area are roughly net about 22 are paying lower, which I think the percentage I put out was 16 or 17% of the portfolio. The total being paid by that same universe actually went up in April from what it was in February, which is the easiest one to compare to. So net, we haven't really seen a whole lot of erosion. It's just a matter of which one. If you happen to own, if you happen to own all 24 of the ones that went down and no others, yeah, you're going to have some income erosion. But that's unlikely. So overall, I think we've gotten through the higher interest rate impact on high yield securities pretty well so far. Okay.
All right, Mike, you want to try again? I saw you raise your hand again.
Yes. Can you hear me now?
Yes.
Oh, yeah.
Great. Okay. Hey, I wanted to circle back, and you mentioned the word ETF, and by the way, I'm a very, very long-term follower of you. I've spoken to you a couple times.
I know, Mike. I recognize your name from way back.
Yeah, okay. Anyway, in your original book, ETFs, which were new at the time, you weren't very excited about them.
Yeah, I kind of panned them, really.
Yeah, but anyway, following on the Facebook page, I noticed you mention them from time to time, and you mentioned you have like 10 that you deal with. Right. I started in, I know you didn't list those funds, so I had to do research on my own. I found 3 I'm in, and I'll mention them: YYY, PCEF, CEFS, which are all ETFs that hold closed-end funds.
Yep.
And they pay very good income. I slowly have gotten in them. I would like to hear the other ones so I can research them and maybe add some. I don't know.
Okay.
able to do that, or and then what obviously you've got them, they must be good now. So
Okay, again, under
and I get
under
it, strictly
under the
recommendation.
shield of the caveat in red on this thing, that any mention is just that they exist. All right, so
Thank you, sir.
all right, so here they go. There was one other that is into just closed-end funds, and that's the Charlie Edward Frank FCEF, but its yield isn't nearly as good as the others. Okay, so the other ETFs I use because of this gives me the one of them I believe is in well, anyway, here's the list. They all pay well. BIZD, QYLD, RYLD, and XYLD. I use them primarily in very, very large portfolios where a total loss would not be a disaster. Okay? That's very important. They're ETFs. I find them just in concept more risky than closed-end funds. And these are the ones that I feel the yields are so good that for people that can afford to have the risk of owning them, and myself, I do include them in the portfolios.
Yeah, the 3 YLDs have treated me real well.
They do spit out some income. That's for sure.
So point well taken. Approach with caution.
Yeah, I mean, if you're like most of us, I imagine, with under a 7-figure portfolio, no judgment here, but if you are, you don't need them with all the other things you have available. And if you do use them, just understand that there may be more risk involved in these than other things because they're not managed. They're sitting there. Okay. Does that answer it, Mike?
Absolutely. Thanks very much.
Okay, good. Any other unrelated questions that anybody wants to bring up before we get on to the next one? Okay. Question 5 is a selling question. Strategy on selling them. Do we stick to a certain % gain? Do we sell the dip? Do we sell the ones you just bought in the dip and then sell it as soon as it reaches a certain %? I could say yes or no to any of those questions. It varies for me. There's 2 things it depends on: where we think we are in the market cycle, and the way you can tell where we are in the market cycle. How many of your selection universe or your owned securities, the ones you own, how many are down a lot? Knowing those 2 facts should dictate to you the answer to this question, which I think long term, what actions can I take that will be best for the portfolio income prediction, income production over the long haul? So in other words, I'm sitting there today and I've got everything in the red except 5, 6 positions. And if I sell those positions at the most profit I can get, which is a very minimal profit, I will generate, let's say, $50,000 that I can reinvest in these portfolios. And let's say if it's 10,000 each, I could add to 5 different positions probably of securities that are right now yielding more than the one I just sold at a very, very minimal profit, but not at a loss, and reduce the cost basis and increase the yield on that position. Even if that was a position that had, previously reduced its dividend, I can still get that back, so to speak, by adding more shares. So if the answer to that question is, hell yes, I've got, 70% of my portfolio is down more than 10%. Yeah, I'm going to take any profit I can to make it better for the income production down the line. And what else have I accomplished at the same time? Since I've reduced the cost basis, those positions are going to mature faster on the road back up, right? So let's say I'm taking something from 10% to 6%, and 6 months from now, everything's rosy again and prices are starting to get into the green. I can sell one of those guys because it's at a lower cost basis than it once was, and I'll still have a whole bunch of securities that are still down enough that I want to add to them. You see what I mean? So I can perpetuate that approach until, let's say, we reach the level of 20% or 30 or 40% of the portfolio is now in the green. Then you can start saying, okay, I'm not going to let anything over a 5% profit disappear on me, because we all know the market can go down, and I hope all of you have seen it go down 1,000 points or more in the space of a week or 10 days, because it has several times this year. So, to get into that feeling like I'm doing this to grow my income over the future. It's not an ego trip that I took an 18% profit on this. I could have taken a profit on that one at 4%, and another one at 4%, and another, and spread the wealth around and been a lot more productive income-wise over the long run. Okay? So I use 5% as my must-sell percentage, and most of you could probably do the same thing. But if you're running out of things either to buy at a reasonable yield, which is very unlikely with the number of CEFs in this universe, or you have nothing to yield to, you might want to, it's up to you. I mean, I use 5%, and I'm going to take my top 50 profits every day. Right now, I'm lucky to get 5, but a month from now, I might be taking the top 50 again. And what I usually do is I take at least, in that top 50, I'll take at least one per person, per individual account. And on bigger, larger accounts, multi-million-dollar accounts, I may take 2 or 3. At the time, when we're in a rally, like last September, October, so forth, where you had a choice of, 5 or 6 issues that you could take a profits on, there's no harm with taking one at a time. Look at where the market's going. It'll tell you pretty much if it knows if it knows where it's going, or if it doesn't. Right now, it has no clue. There's too much going on for the market to know what's going, for the market to show you a definite trend other than down. There's so much going on. We need peace. It used to be peace in the Middle East, remember? We probably don't have that yet, but nobody's paying any attention to that anymore. So, anyhow, does that cover it about selling? It's a very personal thing. I know some of you guys talk about a 14% or a 15% profit every now and then, and I try not to say anything, but I think it's unnecessary. There's just too much. It's too easy to make a lot of small profits. I mean, think like the guys whose batting average is over 300 every year. A lot of singles gets the job done.
Yep.
Okay, but there are times like now where I'm taking any profit because things are so down that we have to jump on it. And I don't know, a lot of you have probably run down your cash reserves like I have. And I think I write somewhere where if you run out of money before the correction is over, you've done it right, you've done it correctly,
Yep.
because we can't predict the bottom. So that's why, it's so great to have all this income coming in. I mean, we're only a couple of days away from another boost of money in the portfolio, so we're in good shape. Okay, any other questions on selling? I know it's very important. It's certainly very important that you have that profit-taking discipline. I've never been a fan of buy and hold, and I know that runs against the grain of most of what you've learned throughout your investing career, but it's never been something that I adhere to at all. Okay, next. So next, in question 6, the question is, we seem to be in a correction and a down trajectory. How should we react to this? And all I can say is with a very broad smile. And again, back to the basics. If you've got quality positions, well-diversified, heavy income producers, and you've taken your profits, you're going to benefit from this correction in the long run.
Sounds
And
good.
we can talk about this. I mean, you guys don't all have to agree with me. Okay. I think we really covered the how much to buy and when.
Yep.
Okay, I explained to you how I'm doing it now, and that'll vary from time to time. And again, where we are, portfolio size, market cycle, your comfort level, those are the big things. Here's another one that we ought to discuss, and it's I've gone back. I didn't really go. The question is, what has history taught us about closed-end funds? When the yield curve inverts, as it has, does everybody understand what that means? I think it means when short-term rates are higher than long-term rates.
Yep.
Of course, you're in a riskier environment. The market senses all this stuff going on around us, economically, politically. All this stuff is going on. We've just gotten over this big health scare throughout the world, and that's sort of still in there. And now we have what CEFs do when the yield curve inverts. When's the last time we had an inverted yield curve? I know they've talked about it, but I don't think it's been within the last 10 years, has it?
I think it was 2008, wasn't it?
Was that because interest rates for short-term rates were in the 4% area, weren't they?
No, I'm not sure.
It was, 4.5%, I think, in the years before the financial crisis. I really don't remember. And going back, looking at these long-term histories of these funds, they all seem to wherever they have been. Let's look particularly, one of the most sensitive is these municipal funds, right? And these things have histories. There are 5 of them only 5 of them have less than 16-year history. Some of them are as much as 34 years, like MVF, Mary Victor Frank, one of the BlackRock funds. It's been in around 34 years, and LEO, I think I've owned it almost 35 years. But anyway, these old funds, if you look back at their histories, you'll see that there's never been a serious impact on what they pay based on the relationship between short-term rates and long-term rates. I think CEFs are one of the only securities that gives you the unique opportunity to take advantage of higher short-term rates without selling anything in the process. I mean, if you have a bond portfolio that you want to take advantage of high interest rates on, you got to sell something at a loss to get there if you have individual securities. But with CEFs, you can use the income to add to your position a share at a time if you choose to, and buy the higher yields. So I don't think we need to worry about the inverted yield curve. I really don't. The long-term impact it may have on stocks is another story, just like we were talking about before. High interest rates can impact, let's say, the lower tier NASDAQ issues, the ones that are more risky in debt and don't pay dividends, and you can't get any signals from dividend cuts to know if your bonds are safe or not, you know? Or even some of the bigger companies that don't pay dividends, you don't have that cushion or that buffer that tells you, hey, company just cut its dividend, it's getting in trouble, you know? CEFs are different. When they cut their dividend, it's not because every company that's there has cut their dividend. It may not be related to any dividend cuts at all. It's more internal. So there's no answer to that question, but it doesn't look like it's been a problem in the past. Okay, I guess we're open to any questions now.
Yeah, let's go ahead and open the floor, and maybe if everyone has a question, just raise your hand, and we'll try and do it orderly instead of having everyone speak over each other. James, go ahead.
All right. First of all, thank you very much, Steve, for taking this time, for helping us all. And my question, because when you're doing a lot of this quick profit taking and you eventually you're going to accrue a lot of short-term capital gains,
right?
Hopefully, I suppose. Is there ever a situation to sell one at a loss to get capital loss to offset some capital gain? If you have one, that maybe you feel is a laggard or whatever, you could deploy that money from selling one at a loss to maybe get increased yield somehow or along those lines. And then, do you ever do that?
I do it in two. Yes, I do it. Sometimes I do it because a client will insist upon me doing it because he's got these capital gains that he wants to offset, and we do have some losses in the portfolio that I can do that with. Either actual whole position losses or those pruning type things that I write about sometimes but I usually only do that for more stuff. But anyway, yes, some people like to do that. There are very few of the accountants that work for the clients I have suggested that approach, 2 or 3 for sure. And I accommodate them this year because we had so much cash associated with those so much profits. I invested most of the cash resulting from the loss taking into tax freeze because the rates were higher, So, and that will also help them next year because their taxable income will be lower. I do it for the rest of my book, so to speak, when, like in September and October last year, when the market was very, very high, and you have old positions or positions that have more dollars in them than you'd like. If you look inside at the lots, you may find like some of the old lots are actually only yielding less than 6%. I'll trim those positions to take some losses. So I will do that but I'll do that in tax deferred portfolios as well. So I take losses there, but I'll do that for some individuals. But but I'll try not to make them get to the point where it's a total loss for the year. Like this year, there haven't been a lot of gains, so I'm not taking a lot of offsetting losses and of that nature. I'm just not. I like to do that when the market's up, not when it's down. So I like to minimize those losses. If I never had to take a loss, I'd be happy. But in the real world, it happens. Like the other, where was it? It was back in '08, wasn't it? When it might have been more recently, when the master limited partnerships and REITs and things were giving us trouble for a change, or at least the master limited partnerships anyway. So yeah, you might find some laggards and you can justify it. But I always look at it this, I mean, what is your tax bracket? I mean, if your tax bracket's only 15% or something like that, you're not, you're losing $1 of capital to save 15 cents, So that's how I would weigh it. I'm not a big fan of losing 25, 30 cents or saving 35 cents by taking $1 in losses.
Mhm.
I know that's the way I look at it. But everybody looks at taxes a different way. I mean, I have clients who have smallish, who have 100% invested in municipals and will not take profits on them because they don't ever want to pay a nickel in profits. So everybody has a different way they feel about taxes, and I think it's a very personal thing. So James, that one's pretty much up to you. But yes, in some instances I do take losses.
All right, thank you.
Okay.
I guess another thing, I don't know, it's just a comment more than a question, but I know you don't like to buy and hold, but in a situation like we're in now, is to just hold longer maybe. And then the beauty of it is collecting these distributions while we wait,
Yeah.
right?
Oh yeah.
Even if it's 6 months, could be 6 months, could be a whole year maybe, but
Nay,
if you're getting this yeah.
We've certainly had corrections that have lasted a year in the past. The 87 one did. The 99 2000 thing was about that, I think. 2008 and 9, that was more than a year involved. But yeah, buy and hold as what I'm doing now because it doesn't make sense. Buy and hold means don't sell for a profit to me. And but now we don't have a choice. I mean, we have to buy and hold because we're happy with what we've got. We've done the research, their quality, diversification, income, etc. We're just waiting for the profits to come along. So yeah, we are buying and holding now technically, but not as a strategy, more as a something we have to do because we don't have the option of taking profits.
Yeah. So part of what I'm trying to get out of my brainwashing is watching my the market values go down, day after day or whatever. And the only consolation and what drew me to these closed-end funds is the monthly income and just patience. And try to be patient, not get uptight about it. And
right, I know, and that's hard for a lot of people. And I think, like we said at the beginning, I know you've selected everything properly and you're holding the right stuff. There's never been a correction that hasn't succumbed to the next rally,
Yeah.
And I just don't see it happening. And everything is down, and everything is down. The ones down in the stock market, not as much as the bond market, because the impact on the stock market of lower interest rates is not a direct one-for-one, like the scales of justice. A little bit push up pulls it down by an equal amount, in the stock market, it's a little bit more of a delayed reaction of how interest rates impact. It's more of it takes time for those rates to get into the decision-making processes of corporate governances, you know? So it's not going to be an instant relationship thing like it is in the bond market. So although they're not down 15, 20% like the closed-end income funds, the equity funds have plenty of them that are down more than 10% in my book. So yeah, it's you know, I wrote that article about the intrinsic warmth of red numbers. I think that's what it was called, about how you can look at your portfolio, the red numbers as opportunities to, you know, increase yield and decrease cost basis, instead of as something that you've paid more for than you should have, and it's now a bad position. There's no bad and good here in the stock market. It is what it is. And down is every bit as good as up. It's just putting yourself in a position where you can take advantage of either. And I think that's what we're doing, you know, with the information that's being passed around in these groups. It's helping us be prepared for whichever way the market goes.
Yeah, thank you. I also have a little consolation that I was avoiding the high-tech market, and it was kept going up and up, and it's like, man, and some people are, but being an income-oriented investor, and now you see a lot of these high-tech names are down more than 50%. And like
right?
Netflix, boom, one day, Netflix, 30% haircut. And it's like,
Wow.
whoa, our CEFs are looking a lot better, you know, when you compare them to what else has been happening.
Yeah, because the CEFs might contain, you know, all of those, the big four or the big five techs, but it'll make up 10 or 15% of the portfolio, not 100%. That's the difference. That's the difference.
Facebook was over 370 or something at its high. Now it's 180.
Wow.
That's a huge, you know, yeah. So some of these people that thought, oh, this high tech, they're going to, you know, especially the buy and holders, which is usually the retail, you know.
Right.
So,
Well, see,
yeah, I'm really happy with closed-end funds.
And that's the thing. And that's the other reason. That's why we take profits, because profits are illusory. You know, they're not going to be there forever. For some reason or other. I mean, even look what happened to Exxon when the Exxon Valdez incident occurred years ago. I mean, this was probably one of, at that time, it might have been the highest capitalized company in the world. And they lost 25, 40% of their market value just then, you know? So, and they didn't pay the kind of dividends that closed-end funds do. So, you know, what is it called? It happens.
I'm real grateful for our Facebook groups and the closed-end fund universe. It's changed my life, really.
Yep.
Thank you.
Same
Good to
here.
hear.
Yeah, thanks a lot, Steve.
Oh, you're welcome. So, are we done? Or
That's
is
it
there
for me.
anything else? I don't have any place to go. So
Yeah. I don't see it. I don't see any of the questions popping up. If anybody has a question, raise your hand or just jump in. Otherwise, we can close the meeting.
I'm out of jokes.
okay. In that case, we should quit then.
All right.
For sure. Okay. Thanks, guys.
All right.
All right. Thank you, Steve.
Steve.
Yeah, thank you very much.
Thank you.
Hello.